Wheat is not a niche commodity. It sits at the center of food security and inflation narratives. Right now, a heat-driven drought in key growing regions and heat waves in the Northern Hemisphere are pushing prices higher while global demand remains resilient. Street-level traders, farmers, and food processors watch the charts as if a weather map and a supply ledger had a baby. A rally in wheat reverberates across feed costs, bakery margins, and fertilizer timing. If you own groceries, you own wheat price swings. Understanding this linkage helps explain why markets behave nervously when heat intensifies today. Across the globe, the weather story is simple yet consequential. Unusually persistent heat and dry soils have truncated yields in major wheat belts, from Kansas to the Black Sea, thinning stocks as demand remains robust. Farmers harvest smaller kernels. Farmers in other regions delay sowing or switch to less thirsty crops, turning field margins into risk assessments. The result is a price ladder that climbs when heat spikes and fresh harvests disappoint. This season shows how climate translates directly into quarterly earnings and central bank anxieties. Investors track USDA reports, rainfall forecasts, and weather models as though forecasting a storm. To understand today, you need history. Wheat has long cycles driven by weather, policy, and disease, with prices swinging from a modest $7 to $8 a bushel to double digits during shortages. The 2010-2012 drought in the US and Black Sea tensions pushed futures above 10, triggering export bans and farm budget reallocations. Traders learned to read planting intentions, soil moisture, and pest pressures almost like a quarterly report from a major consumer brand. Since then, supply chains have diversified, but climate risk stayed embedded in the cost structure. The result is a more market-sensitive crop that reacts quickly to heat signals. Markets are pricing the heat into every link of the chain. Wheat futures marched higher, widening backwardation and rippling into feed and bakery margins. Exchange-traded funds, options desks, and hardened hedge funds adjust risk models as volatility ticks higher. Banks reassess collateral, farmers price insurance, and mills lock in contracts to avoid surprises this summer. The price move also affects related markets. Corn and soybeans sometimes drift with wheat, while energy prices respond to biofuel demand linked to grain. Consumers feel the pressure through grocery bills, especially in regions prone to heat waves and droughts, where supply is tight globally. Who feels the heat ranges from farmers to food processors, retailers, and investors. Farmers face higher input costs and price volatility, sometimes receiving better loan terms when futures rise, but also risking margins on crop failure. Milling companies adjust procurement and pass some costs to customers. Food retailers grapple with inflation optics while seeking to maintain demand. Governments consider export curbs or subsidies, while insurers adjust crop coverage. Investors across equities, commodities, and currencies recalibrate portfolios, with some tilting toward inflation hedges and others seeking diversification through soft commodities linked to climate trends. Small producers, local cooperatives, and regional traders also see liquidity shifts and price risk in their planning. Beyond weather, geopolitics, and macro forces steer momentum. Russia and Ukraine remain major grain exporters, and sanctions or blockades change trade routes, pushing buyers toward alternatives and faster logistics. Policy shifts in China, India, and the EU influence fertilizer costs, energy demand, and crop rhythms. Global inflation remains sticky as central banks weigh rate paths against food price shocks. A drought-friendly monsoon in Asia or a sudden harvest upgrade in the Americas can snap the risk premium. But the economic backdrop means even small supply surprises create outsized price moves. The wheat story is inseparable from geopolitics and macro tides. Smart money weighs hedges, liquidity, and correlation. Hedge funds scale into options and futures spreads to capture skew from heat risk, while pension funds tilt exposure toward real assets and inflation-linked notes. Banks adjust credit lines for farmers and mills, while ETFs tilt toward diversified grain baskets. Retail investors follow volatility news and trend lines, often via equity exposure to agriculture or through thematic funds. In the last quarter, risk parity and macro managers increased allocations to commodities, signaling belief that climate-driven scarcity will persist. The lesson is clear. Weather-driven moves invite both caution and opportunistic bets. Bear case scenarios warn that heat may fade unexpectedly, or a bumper harvest could deflate prices quickly, eroding current risk premia. A sudden policy change or a successful counter-drought in major belts could restore supply, triggering abrupt selling and margin calls. Higher interest rates or a global recession would dampen demand, amplifying downside for producers and exporters accustomed to favorable pricing. Storage constraints and logistic bottlenecks can reverse get-rich-quick narratives, forcing inventories into contango as carry costs rise. Additionally, exchange rules, crop disease, or pests could complicate hedges and leave prices detached from farm-level realities today. Retail investors should approach wheat heat risk with disciplined steps. Start by sizing exposure to align with risk tolerance, using simple vehicles like diversified commodity ETFs or a small allocation to quality agricultural stocks. Then avoid overconcentration in volatile names. Build a weather-aware but diversified basket so one crop scare does not derail your plan. Use stop-loss or option hedges to manage downside while keeping upside optional. Track crop reports, weather forecasts, and logistics news weekly, and rebalance as prices move. Finally, remember that time horizon matters. Patience often beats chasing headlines in volatile markets over time gains. Looking ahead, risk management and climate awareness will shape prices for months to come. Heat risks create a floor in memory for producers and a ceiling for consumers, but the path is not linear. Weather, surprises, policy twists, and evolving trade routes will continue to tilt the odds. Investors can watch for inflation sensitivity, commodity correlations, and yield curves as clues to the next move. The takeaway is resilience through diversification, disciplined capital allocation, and an informed view of seasonality. Stay curious. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.